What we are witnessing right now is not a typical breakout, and it certainly isn't just another volatile trading session. This is the point where a market stops behaving like a market and starts behaving like a stress test for the entire financial system. For weeks, the warning signs were visible to anyone willing to look. Silver's paper price drifted higher in an almost unnatural way, disconnected from fundamentals, floating as if gravity no longer applied. That only happens when confidence is manufactured rather than earned. And artificial confidence never fades slowly. It fails suddenly. By the time Asian markets opened, that illusion was already cracking. When New York traders logged in this morning, they didn't walk into a calm environment looking for resistance levels or trend confirmations. They stepped into a vacuum. Silver didn't grind higher. It jumped. Within hours, prices blasted through levels that were expected to take months to reach. Futures briefly touched the mid-80s before settling back into the low 80s. A move like that at these price levels is not noise, it's force. But focusing only on the New York screen price completely misses the real story. Judging this event by futures alone is like judging a hurricane by a puddle on the sidewalk. The real signal came from the other side of the world. While Western traders debated whether $82 would hold, the Shanghai Gold Exchange quietly posted a physical silver price north of $91. That is not a dealer premium or a panic quote from a fringe buyer. That is an official physical market price, nearly $9 above New York. That spread is not an opportunity, it's a diagnosis. It tells you the pricing mechanism itself is breaking down. One market is leveraged, synthetic, and dominated by paper promises. The other demands that metal actually exists. When those two prices diverge this violently, it isn't disagreement. It's a verdict. Physics doesn't negotiate, and neither does a buyer who needs delivery. If silver were truly worth $80, nobody would be paying $91 for it. Markets don't work that way. The higher price is the honest one because it clears supply. The lower price only survives because it doesn't have to deliver. Once that gap opens, it becomes self-reinforcing. Metal flows toward the higher bid. Western vaults drain. The paper market is forced to chase reality higher, whether it wants to or not. The price action we saw today tells you exactly where the pressure is coming from. We opened near $80, dipped briefly below it, and then something snapped. The surge from the high 70s into the mid 80s was not retail enthusiasm, it was mechanical. That kind of vertical candle appears when a large short position loses access to collateral. A risk model flips from manageable to emergency, and an algorithm starts buying without regard for price. It buys because it must, not because it wants to. We've seen this before. Nickel in 2022 followed the same script. A concentrated short position, a sudden physical imbalance, and then a vertical move so violent it breaks the exchange itself. Trades are questioned, rules are rewritten, and price discovery suddenly becomes flexible. Silver hasn't reached that stage yet, but the footprints are unmistakable. You'll hear a lot of commentary about the wick on today's candle. The pushback from the highs will be framed as rejection, as smart money selling into strength. That narrative is comforting, but it's wrong. That wick isn't confidence leaving the market. It's fear revealing itself. Shorts are defending that zone because they understand what a sustained move above it implies when Asia is already paying far more. Insolvency stops being theoretical. They threw paper at the market, volume meant to intimidate, contracts that don't represent real metal. And what did it accomplish? A green candle, higher lows, and a rebound that took minutes instead of days. That's what a failing suppression mechanism looks like. The timing matters. Gapping higher on a Monday is not random. It means pressure built while markets were closed. Something happened over the weekend that couldn't be managed intraday. That creates a psychological problem for anyone still waiting patiently for lower prices. Those hoping for $75 suddenly realize the train may have left the station. When that realization spreads, it fuels the next leg higher, not because of greed, but because of fear of being structurally underexposed. This kind of market is not gentle. Volatility becomes the last weapon available. A sharp pullback would not be surprising. A dip into the high 70s would look terrifying on short-term charts. But in context, it would simply be a retest of the breakout. Healthy markets retest. Broken ones fail to bounce. There's also a very real chance that no retest comes at all. With a $7 to $9 physical premium in Asia, silver may continue stepping higher until exchanges are forced to intervene. Trading halts, position limits, rule changes, those are not signs of strength, they are signs of stress. At this point, silver isn't moving because it suddenly became more valuable. It's moving because the measuring stick is failing. What you're watching isn't just a silver chart, it's a chart of confidence in the currency used to price it. And that confidence is leaking fast. Anyone trying to buy physical metal today will feel that immediately. Dealers are not quoting screen prices, they're quoting availability. Some are asking triple-digit numbers, others simply say no. That isn't manipulation, it's rationing. Paper has one price, metal has another, and the gap between them is the real story. While traders argue over candles, industry is dealing with a nightmare. Companies like Samsung, Tesla, and major solar manufacturers don't care about momentum indicators. They care about keeping billion-dollar production lines running. Silver is not optional for them. It's a bottleneck material. Solid-state batteries, advanced electronics, high-efficiency solar panels, these are strategic technologies. Contracts were signed assuming that London and New York could deliver metal on demand. That assumption cracked the moment Shanghai printed above $90. Anyone who understands logistics knows what happens next. Metal flows east. Western availability tightens overnight. If you're responsible for supply, you don't wait for a dip. You secure ounces. Price becomes secondary. Downtime is unacceptable. That's why industrial buying creates a floor no paper seller can break. Once that metal is bought, it's gone. A huge portion of silver supply has effectively gone dark. It hasn't vanished. It has stopped participating in public price discovery. Insiders call this ghost supply. Metal moves directly from mine to refinery to end user, bypassing exchanges entirely. From the outside, it looks like silver is disappearing. In reality, it's being locked away by buyers who fear waking up without it. Standard economic models fail here. Higher prices don't kill demand for mission-critical inputs. Silver is embedded in systems that cannot function without it. A small increase in cost doesn't matter when the alternative is shutting down production. In fact, demand can accelerate as fear sets in. Paying $100 for metal you can touch is preferable to paying $80 for metal that never arrives. This is price inelasticity in the real world. Banks can sell paper all day long, but they can't fabricate atoms. Militaries can't fight wars with derivatives. Solar panels don't run on futures contracts. Physical silver is winning because it has to. Refining capacity adds another constraint. Even if silver exists underground, it takes time, energy, and labor to turn it into deliverable metal. Refineries are already running at capacity, booked months in advance. That puts a speed limit on supply. Immediate metal is worth more than promises of future delivery. That condition has a name: backwardation. It's one of the clearest signals of physical stress in any commodity market. For decades, supply chains were optimized for efficiency. Just-in-time inventory was gospel. That philosophy quietly died this week. We're moving into a just-in-case world. If manufacturers decide to triple their silver buffers, demand doesn't rise gradually. It explodes. That's the shock now rippling through the system. When you see volatility, understand that it's surface turbulence. The real action is happening behind closed doors, in procurement meetings, military logistics briefings, and refinery scheduling calls. Calling this a bubble misses the point. Bubbles are excess capital chasing optional goods. This is scarcity colliding with necessity. Liquidity from the public is the exit ramp for banks trapped short. That's why the ETF trap exists. Buying paper exposure during a physical shortage doesn't squeeze supply. It feeds the system. Ownership and exposure are not the same thing. If you can't hold it, you don't own it. Central banks understand this. Industrial buyers understand it. The public often learns it too late. As shortages spread, behavior changes, delivery times stretch, premiums explode. Call for pricing replaces automated quotes. At that point, physical silver has already crossed $100 for anyone actually trying to buy it. The split becomes complete. A paper market exists alongside a physical market, and they no longer speak the same language. History shows that when this happens, paper eventually surrenders. Reality always sends the final margin call. This is the classic sequence. Smart money moves quietly. Industry moves aggressively. The public arrives loudly. When retail enters en masse, price stability disappears. $5 daily moves become normal. $10 days stop being shocking. This is early-stage mania, not the end. And yet leverage is the graveyard here. Volatility will be weaponized. Flash drops will happen. If you're overextended, you can be right about everything and still lose. Physical ownership removes that risk. An ounce remains an ounce regardless of screen price. Where does this end? Once an asset enters true price discovery, charts lose relevance. Measuring silver purely in dollars becomes misleading when the dollar itself is losing credibility. A better lens is relative value. For centuries, silver traded much closer to gold than it does today. That ratio is now collapsing. Even here, silver remains historically undervalued. Triple digits matter psychologically, not fundamentally. When that number prints, attention will explode. That's when emotions peak. The real exit is not silver for dollars. It's silver for real assets, ounces to acres, silver for productive businesses, energy, land, infrastructure. That trade happens later, when silver buys disproportionately more of everything else. We're not there yet. This is still acceleration. The old world of abundant, cheap silver is gone. We're entering an era where resources matter more than promises. This repricing didn't start because people got excited. It started because the system ran out of slack. Hold steady. Ignore the noise. Understand what you own. The future doesn't belong to those with the fastest trading apps. It belongs to those who hold tangible reality while the rest of the world argues over numbers on a screen. If this perspective helps you cut through the noise and understand what's really happening beneath the headlines, make sure you subscribe to the channel. This is John Money Discipline. And if you want clear thinking, long-term strategy, and reality-based analysis as this transition unfolds, subscribe now so you don't miss what comes next.